Hey, accounting students. This is our video lecture series for Chapter 4, dealing with inventory, merchandise inventory. So this Chapter 4 series will probably have 3 or 4 videos. So this is the first video, part 1, where we'll get an overview of how this merchandising activities are going to be recorded. So in past chapters, though, we weren't selling merchandise. We were selling services. For example, an accounting firm selling their accounting services, or lawyers selling legal services, or plumbers selling their plumbing services. But here in chapter 4, we're going to be selling a product, merchandise, some type of goods. In either case, service type companies or merchandising companies, we're going to earn revenue. So we learned how to record revenue in past chapters. But to make revenue, to earn revenue, we have to incur expenses or costs. So we're going to take that revenue and minus out those related costs to get the company's profit, here called net income or net earnings. Now, in the case of a merchandising company selling products or goods, we're going to have an extra step here. We still have revenue being recorded first, but now the first thing we subtract out is not all of the expenses like we saw in the previous example for service type businesses, but we're going to subtract out one of the big main costs of a merchandising company, and that's the cost of the merchandise we just sold. So these two figures really are the same merchandise, but in this case, the first figure is the money owed to us by our customers. And this second figure is that same merchandise, but how much we paid for that merchandise. And we take the difference, and that difference is called gross profit. But just like service type companies, our merchandising company also has other types of expenses that we need to incur, like maybe rent or salary expenses or taxes. So we subtract those expenses out to get the company's bottom line or the net income. So here's 2 examples of different types of companies. Of course, in the case of H&R Block, we know they sell their tax preparation services. So here's the revenue they earn, and we minus out all of their expenses in this condensed short income statement to get their bottom line, their company's net income. But in the case of a company like Nordstrom, who sells merchandise, it's a retailer, they're going to have revenue at the top. In the case of a merchandising company, their revenue account is called sales. We'll learn in a different video how we calculate this figure called net sales. But here, revenue at the top. And then the next figure we show is the main expense of the business. Even though you don't see the word expense at the end of this description, cost of goods sold is treated just like an expense. We subtract it from the revenue here to get a difference called gross profit. Once more, these 2 figures, net sales and cost of goods sold, are dealing with that same merchandise. In the case of sales, net sales, this is the money we expect to collect from our customers for that merchandise. And for cost of goods sold, this is what we gonna pay. Our company, Nordstrom, is gonna pay for that same merchandise that was sold to our customers. And the difference between the two is the profit we made for the period for selling that merchandise. And just like a service type business, a merchandising business also has all of those other so-called operating expenses like rent, like salaries, that we subtract out from the gross profit to get the company's bottom line of net income. Here you can see we're dealing with millions of dollars. So basically, Nordstrom purchased something like almost $10 billion worth of merchandise and resold it to their customers for $15.5 billion, resulting in a profit of $5.6 billion. Okay, that's the profit they made from buying and reselling. But then again, we also have to subtract out all the other expenses Nordstrom incurred for the period. Again, like rent expense or salary expense to get their bottom line. Okay, so we're taking this extra step here, subtracting out the cost of the merchandise for a merchandising company, which a service type company probably wouldn't have. Now there is possibilities of a company having both service income and merchandising income, yeah, but this would be the extreme, just service revenue, just merchandising revenue. Here's something called an operating cycle, which we kind of learned about back in the previous chapter, chapter 3. But in the case of a merchandising company, to be able to sell merchandise, they got to buy that merchandise in the first place. So here we buy the merchandise and put it into an asset account called merchandise inventory. So it's sitting on the shelves right now, maybe sitting in the warehouse, ready to be sold. Now, when we sell it, we can collect the money right away. So that would be a short cycle here. Yeah, you buy and sell and collect the money. But for many merchandising companies, they sell, but they only bill their customers, here called credit sales or sales on account. So here's the bill, creating an asset called accounts receivable. So now you're waiting and waiting, and hopefully you can collect the money right away. And here's the money coming in. So the time it takes to purchase the merchandise and to sell it, and then eventually collecting the money, is one operating cycle for a merchandiser. There can be variations, yeah, because again, you can sell right away and collect the money. And if you buy on account here purchases, maybe you can wait to spend the money to pay off your bill using something called accounts payable. Here's an illustration of how the merchandise is flowing or how the cost is flowing. So here at the beginning of the period, maybe the beginning of the year or beginning of the month, is stuff that we didn't sell from the previous month, the previous year. So at the start of our current year, sitting in your store is the beginning inventory. And then during the month or year, here's how much we're buying from our suppliers. And together, adding it up, that's the maximum you can sell here called merchandise available for sale. And there's only two things we do with this merchandise available for sale. Either we sell it, here called cost of goods sold, going to our customers, or we don't sell this merchandise available for sale, here still staying in our store or warehouse at the end of the year called ending inventory. So these two items here have to equal these two items here. Again, the middle total here is called merchandise available for sale. And we're continually buying during the year, yeah, restocking our shelves. And we're continually selling during the year or whatever period we're looking at. Here, merchandise going to our customers. Let me illustrate this maybe slightly different. So let's say that this box here represents our store. And sitting in our store at the beginning of the year is stuff that was unsold from the previous year. Here we call that stuff beginning inventory. That's this item here, yeah? And then during the year, we buy more merchandise. We call that purchases. It's coming from our suppliers, maybe from a wholesaler, maybe from the manufacturer. And we were stocking ourselves because hopefully coming out of our store is stuff we're selling called cost of goods sold. Again, this is going to our customers. Okay, so we're buying and then we're selling it out, yeah, including this stuff we didn't sell from the previous year. So now at the end of the period, at the end of the year, there's still stuff on our shelves unsold, and that's the ending inventory. In other words, these two here, what we start off with plus what we buy during the period, again, be it a month or be it a year, has to either be sold going to the customers, here we call it cost of goods sold, and the things we don't sell, the ending inventory. Again, these two here have to equal these two here. Now, we learned in the past couple chapters how to record transactions using debits and credits. This store account, this merchandise account right here, is an asset. Remember, something you own that has value. So let me set up the T account for our new asset account called merchandise inventory. We know the left side of the T account is a debit. And in the case of an asset like inventory, that's the increasing side. And when we reduce the asset, we record the amount on the credit side. So sitting in this merchandise inventory account at the beginning of the year is stuff we didn't sell from the last year called beginning inventory. Normal balance is a debit for an asset. And then when we buy more merchandise during the year, we're going to increase this merchandise inventory account with more debits. Again, that increases are the purchases we buy from our supplier. And then we, let me go back here. Where am I? And then we sell the merchandise. We're going to reduce this inventory account. Again, we call that the cost of goods sold. Crediting merchandise inventory for whatever we're taking out of the store. And then whatever is left over at the end of the period, you can figure that out by adding up these two. Remember, these two here have to equal these two over here. So we know this number here, the amount that left. So what's sitting on the shelves at the end of the period is the difference of this minus the cost of goods sold. Really, it's going to be a debit balance. Here, the ending inventory is a positive debit balance. In other words, this two equals these two over here. Ending inventory plus cost of goods sold. Okay, let's stop here, and when we come back, we're going to take a look at recording transactions when we purchase merchandise.